Hi, I'm Ross from Lifetime Property Accounting, and we're going to talk about interest limitation today. We're going to look at what is the effect of interest limitation on a stock standard rental. So, this is a property that recently came up on my feed. So, it's an older Hamilton property. We can tell that it's obviously not brand new. It's an older property. It needs a little bit of work. It's just sort of stock standard rental, something older, something that needs a lot of work. So, we're going to look at what the cash flow is. And rather than focusing on the cash flow, like obviously the numbers are very, very important, but what we want to do today is focus on what will happen with the interest limitation. So we've got a standard sort of property, 650 a week of rent. We're working on 51 weeks, 33,150. So obviously, if you're looking at buying this property, you'd talk to the property manager and you'd look at what the rent is, what's the expected weeks, how easy it is going to be to rent. And the same, all the expenses, you look harder at the insurance, the rates, the repairs. I've just put in basic estimates to them. They're not perfect. It's just to give an idea of a basic first investment property for someone. So this one receiving $33,150. We've got all the expenses out. Obviously, the big one, we're using 4.6% for this example with 1 year rate at the moment. Expenses 44,000. So we're losing about 11,000 a year. So to me, yes, you can definitely do better. This is not a great rental. I'm not recommending you go out and buy this, but this is a stock standard rental. Lots of people lose about 10 or $11,000 on their rental on an older property. So this one's sort of a common example. So what happens if interest limitation comes in? And what happens if we're not allowed to claim interest? So we've obviously got the same rent, all the expenses are the same except for the interest. We won't be able to claim interest. So, yeah, rather than having a loss of 11,000, we've got a taxable profit of about 19,000. We'll start off with no depreciation, and obviously we'll come back to that. It's going to be a key trick that's going to reduce the profit. So, with no depreciation, we would currently, under current rules, be allowed to claim all the interest, have a big loss. That loss, if it was our only rental, would carry forward. It's ring fenced, so it can't offset our business income or our PAYE income or any other income. It's ring fenced. That 11,000 approximate loss will carry forward to next year. But if interest limitation is fully in play and we can't claim any interest, we'll have a profit of 19,000. At the moment, zero chattels. So if we're at the 33% tax rate, we'd have to pay about $6,000 off tax on that fake profit. It doesn't really exist. We're not really making money, but we're still having to pay tax on it. So we'd be looking at $11,000 cash loss plus paying 6,000 tax. You'd be overall looking at losing about 17,000 off cash a year, which is obviously a large amount that's going to put a huge strain on most property investors. Biggest tip, and this is the biggest tip if you've got profit in properties anyway, but the biggest tip if you're trying to reduce your profit, reduce your taxable profit, reduce your tax if interest limitation comes in, is chattels depreciation. We can't depreciate buildings anymore, but we can still depreciate chattels, the carpets, the curtains, the dishwasher, the stove, the heat pumps, the fences, the decks, the driveways, the paths, all the different items. So yeah, we might have, I don't know, $4,000 off depreciation. So that would reduce our tax bill down by a bit over $1,000. So it means that we're not quite losing so much. In this case, with full interest limitation, still looking at losing about 16,000. So yeah, interest limitation is a huge problem. It's going to have a huge impact if it comes back in. And yeah, we do not know whether it will or won't come back in. It's possible it could go either way. So just something to watch out for, something to think out a little bit. Yeah, biggest things would be you definitely think about those chattels valuations from Value It. And the other one would be maximize your loss. If there's anything you can do now that's going to give you a bigger loss carried forward, if interest limitation comes in, that's going to be a bigger loss that you can offset against future profits. So that's going to give you a big benefit. So yeah, make sure you do those things. Make sure you maximize any losses now. Don't just think, oh, I've got a loss. I won't worry about chattels depreciation because it won't matter. Or it might matter later if something like interest limitation does get in. And just be, yeah, I'm very clear. I do not know whether interest limitation will or won't come in. Yeah, to me, maybe running probably 60-70% no at the moment. But there is still a reasonable chance, maybe 60-40, 70-30% chance that yeah, interest limitation will come in. So it's worth thinking about how it will affect you. And at this stage, we'd had no idea, is new homes included? They were excluded last time, but why? We're building too many houses anyway, and there's way more consents in buildings than is needed. Social housing, again, why was that excluded? Why is that a different, yeah, different to an older property providing a home for someone? Who knows exactly how the rules will come in? Will it be 100% interest limitation? Will it be 25%, 50%? Yeah, we do not know. Hopefully you found that useful, and hopefully it helps with your planning. Thanks a lot. Bye.